Okay, everyone, let's start a question on depreciation. I've taken an example to explain how to find depreciation, how to make a cost account, and how to make a disposal account. So, there is a question. Two vans were bought on 1st Jan 2022 at $10,000 each, paying by check. So, you have bought two vans. The total cost of two vans would be $20,000. On 30th June 2023, that is next year, a new van was purchased as $12,000 on credit from X Limited, and on the same date, one of the old motor van was sold for $7,000 on cash. Now, the most important part is the depreciation policy. You need to understand the key element to solve the question is the depreciation policy. So, the depreciation policy says 10% per annum using a straight line method. Policy is to charge full year's depreciation in year of purchase and year of disposal. So this is a very important line. You need to understand what your examiner is expecting you to work on. So the policy says that full year depreciation is charged in the year of purchase and sale. It means there is no working for the month wise for this particular question. You have to charge the entire year's depreciation. So dates of sale and dates of purchases are becoming irrelevant in this requirement. So you need to understand the policy first before starting your working. So let's begin with the question requirement. First one is to draw up a motor van account. That is actually a cost account. Everything will be updated in this account on cost. So I'm making a ledger with a debit side and a credit side. The year of purchase was 2022 dollars, 2022 dollars. Debit side and credit side, write the years and the currency. That is must. And the year of purchase was 2022 January 1st. So the general entry that you are going to make is motor van debit and bank credit in the van account. On January 1st, you will write bank with the value of $20,000. Okay, so in 2022 there is nothing else happening. There is only a purchase of two vans and there is no disposal or another purchase in that particular area, so you need to close the account. The debit side total is $20,000, which should be equals to credit side as well, December 31st. Accounting year in this question is ending in December 31st because the year starts on 1st January 2022. December 31st, balance CD 20,000. Year is complete. Now coming on to 2023. January 1st, balance brought down $20,000. So let's continue with the next story. On 30th June 2023, a new van was purchased at $12,000 on credit from X Limited. So in this particular transaction, there is a purchase of motor van. The transaction would become motor van debit and X Limited would be credit over here because the van is purchased on credit. The other party becomes your trade payable. So next story would be debit June 30th, X Limited. Liability increases over here with $12,000. And on the same date, one of the old van was sold for $7,000 on cash. Now this is the twist over here, that there is a disposal as well. On June 30th, you are going to record disposal on the credit side because asset is being disposed, asset is being sold with $12,000. Sorry, with $10,000. So here is a catch over here, that the amount at which you have bought the asset, the disposal account in the cost account of the credit side will be the same amount. The $7,000 which is received by the business on the disposal will only be recorded in the cash book. So I am repeating myself. In the cost account, everything is going to be on the cost. The price at which you have purchased the non-current asset, it will be recorded with the same amount. So on the credit side, I will write disposal and the $10,000 because the motor van which was sold was bought in the previous year for $10,000. So you need to understand it very clearly that the cost account only records the cost values, either you are selling it after 3 years, 2 years, or after even the same year. So the cost account is completed now. In the 2023, you have bought a new van and you have disposed one on June 30th. I have recorded it. You need to close the account. The debit side is $32,000. Credit side should be $32,000 as well. The difference is $22,000. That is your balance CD amount on December 31st. I hope it's clear to all of you. So this transaction will be debited in 2024, January 1st, $22,000. So the cost account is completed over here. It's the same format which is going to follow on all the questions set on this particular topic. Let's come on to the depreciation account, provision for depreciation. Provision for depreciation on motor van. Let's make a ledger. I'm using another color pencil over here. 2022 dollars, 2022, and a dollar figure. So let's start with the working of depreciation for the particular year. I'm using space over here. Working number 1, depreciation of 2022. Straight line method. The formula is cost minus scrap value into percentage. In my example, the cost of 2 motor vans were $20,000. There were no scrap value written in the question, and the policy was 10% straight line method. A straight line method is always applied on the cost of the particular asset. So I will multiply $20,000 with 10%. The depreciation charge for the year would be $2,000. That is the working number 1. That is your income statement answer. What would be the journal entry that are you going to make? Income statement debit, provision for depreciation credit. Income statement debit by 2,000. Provision for depreciation credit by 2,000. That is the journal entry. Okay. So in provision for depreciation account, it will be credited. You will write December 31st. Depreciation will be charged at the end of the financial year. So I am taking December 31st. You will write income statement. Write complete in the exam. I am just using the short form to make it quicker. $2,000. There is no other transaction in year 2022. Just balance the account. There is 2,000 on the credit side. Debit side should also be 2,000. The remaining amount would become your balance carried down. December 31st, balance carried down. Year 2023. January 1st. January 1st. Balance brought down $2,000. Now we need to find income statement answer of the next year. That would be my working number 2, and that was working number 1 when we found $2,000 for 2022. So in 2023 there are 2 different non-current assets which were bought in the last year and the new one which is bought in 2023. So the working should be correct in your exam. Let's take another pencil over here. Working number 2. I am breaking 2 non-current assets to find depreciation of 2023. The policy was full year's depreciation will be charged in the year of purchase and disposal. Either you are disposing asset in middle of the year, at the end of the year, or even at the start of the year. The depreciation charge would be for the entire year according to the policy. That is the most important catch of any question. You need to understand the policy which they are testing in the exam. So in 2023 you had 2 different sets of motor vans. Once 2 which were bought in 2022. So I am working using 2 different motor vans which were bought in 2022. The formula would be the same. $20,000 minus 0. There were no scrap value into 10%. You will get $2,000. and one motor van which is bought in 2023 with the cost of $12,000 minus there is again no scrap value into 10%, $1,200 of the new van. So the depreciation charge for this year would be $3,200. That is the income statement amount. The general entry would be income statement debit, provision for depreciation credit with the amount of $3,200. I am repeating my working again. Two motor vans which were bought in 2022. I have charged depreciation with the same amount, 20,000 minus 0 into 10%, that is straight line method. And one motor van which is bought recently in June 30, that is $12,000 minus 0 into 10%. So you will get a total depreciation of $3,200 for this particular year. Working 2 is complete, $3,200. Now there is one more working which you are going to do, that is June 30th, disposal. Working number 3, that is the provision for depreciation of the entire 2 years of that asset which you have sold in 2023. So you need to do another working to find accumulated depreciation of the particular asset which is sold. So let's do working number 3 with a different color. I am finding disposal figure of accumulated depreciation of the motor van which was bought on 1st January 2022 and sold on 30th June 2023. So there are 2 years which the motor van was used in the business. Year 1, 1st January 2022 lasting 31st December 2022, that is year number 1, and next year 1st January 2023 ending at 31st December 2023, that is your year number 2. So the accumulated depreciation of this particular asset would be charged for the 2 year of time period. Again, I am following the policy. The policy says that depreciation would be charged in the year of disposal as well. So you need to charge depreciation for the entire year. So the accumulated depreciation of this particular asset must be, for year 1, the cost of motor van was 10,000 minus 0 into 10%, that is $1,000. And for the second year, the working should be the same. You must have got $1,000 for the next year as well. So the total accumulated depreciation of this particular non-current asset was $2,000, that is charged in the period of 2 years of time period. So this is the disposal, this is the depreciation, accumulated depreciation of the asset that is being sold, comprises of the 2 year of time period of use. I will debit this amount on the provision for depreciation account, $2,000. Now the depreciation account is completed. Let's balance it off. Credit side total is 5,200. Debit side should be the same. The difference is 3,200, that is your balance CD amount. December 31st, let's change the year, 2024, you need to show the balance BD, 3,200. This is how we make provision for depreciation account. The working would be done for income statement amount, that is depreciation charge for the year, and the disposal amount, the accumulated depreciation of the particular asset which is being disposed by the business. So I hope it is clear to all of you. And lastly, the disposal account, all the workings are done. You just need to put figures in the disposal account to wrap up the question. Let's make a disposal account which we had discussed in the lecture as well. When do we make disposal account? When we dispose any non-current asset in a particular year. So all the workings are there in the question. Disposal was done in 2023, dollar figure. Now just follow the double entry system. The cost account was debited with $10,000 and the same amount will be debited in the disposal account, motor van. All the dates were June 30th because the disposal was held on this June 30th of the particular year. So the cost of motor van was $10,000 debited. How much cash the business has received on the disposal? That is $7,000, that is received by cash. That particular entry would be cash debit and disposal account credit. In the disposal account, you need to put this figure on the credit side, cash $7,000. Now the provision for depreciation of the particular non-current assets, I am following again the double entry. The accumulated depreciation, provision for depreciation debited which was 2000, and disposal account should be credited with the same amount. So you are going to put June 30th provision for depreciation, that is accumulated depreciation of this asset, that was $2000. Account is complete. Now you need to find either you have done a profit or a loss on the disposal of that particular asset. Now clearly you can see the debit side is larger than the credit side. Both should be equals to each other. The difference of 1000 that is being found on the credit side, that is your income statement amount. And I had also explained it in the lecture video that if you find income statement balance on the credit side, it means it's a loss. You have incurred a loss of $1000 on the use of this motor van after disposing it off in 2023. So I hope the lecture is clear to all of you along with the practice. So the key element is the depreciation policy, which is stated in the exam. Sometimes they say full year depreciation is charged in year of purchase and none is charged in year of disposal. Sometimes they say depreciation policy is to charge depreciation for the time that asset is held in the business. So you need to read the phrases to make your working correct. So if I change policy of this question, what figures might be changed? Let's take an example as well. Let's suppose question says, I'm just erasing this figure. Policy is to charge depreciation full year in the year of purchase. Okay everyone, let's take an example of another policy that might be tested. If the examiner says that policy is to charge depreciation for the full year of purchase and none is charged in year of disposal. So in this particular question there would be certain changes. Let's say the cost account would remain the same. There would be no changes in the cost account. The depreciation working for the second year would be changed over here. So in my example, the depreciation charge was to 3200 for the next year. Now this particular example, when the examiner says that depreciation would be charged for the full year in the year of purchase, but none is charged in year of disposal. So none is charged in year of disposal means in year 2, the working of 2 motor vans will be replaced by working of only 1 motor van depreciation. That would be one motor van for the last year, that was $10,000. $1,000 for only 1 motor van, because year of disposal there would be no depreciation charge for the asset that is being sold. So this particular year the total would be $2,200. So working of 3,200 will be replaced with $2,200. And there would be another change, that is provision for doubtful debt of disposal, that is accumulated depreciation, working number 3. In working number 3 we had discussed 2-year depreciation according to previous policy. Now if the policy says there is no depreciation charge in year of disposal, then you are not going to do charge depreciation for the next year, that is 2023. The accumulated depreciation would be only for the 1 year, that is 2022. So answer of accumulated depreciation would be changed with $1,000, and in disposal account this amount would be changed with $1,000. So the loss of $2,000 would incur if the policy says there would be no depreciation charge in year of disposal. So there are multiple policies that are tested in exam. You need to very much concise in picking up the policy and then carry out your working. So the answer of working would be income statement charge and disposal of accumulated depreciation. These two workings need to be concisely done by looking at the requirement of the question, and inshallah we are going to solve couple of more questions of examiners past paper. In order to have a clear understanding how to solve exam questions, I have given you an illustration with my question of 3 different accounts, that is cost, provision of depreciation and disposal account. And I will try to do 2 different questions of past paper in order to explain this concept in more easy way. Okay, everyone. Let's start with another question on depreciation that came in November 24, paper 23, question number 4 in paper of O-level accounting, that is syllabus code 7707. So let's begin with the question. A company has a fleet of delivery vehicles. Information from their statement of financial position at 31st December 2022 shows that the vehicles originally cost 440,000 with accumulated depreciation of 270,000. Okay, accumulated depreciation is the previous depreciation that is charged in previous years, and if we deduct 440,000 and 270,000 together, we will get net book value of these particular delivery vehicles. The business purchased 2 additional vehicles costing a total of $70,000 on 1st April 2023 on credit from L Autos. Okay. On 30th November 2023, the business sold one of its vehicles. The vehicle had originally cost $28,000 with accumulated depreciation of $16,800. The vehicle was sold for $10,500 to the local garage who paid by bank transfer. Okay. The business provides for depreciation using, the very important line is over here, the policy. The business provides for depreciation using a straight line method at the rate of 20% per annum. A full year depreciation is charged in year of purchase. No depreciation is charged in year of disposal. So these 3 lines are the most important lines of this question. Examiner says only the depreciation that is charged in the year of purchase, a full year's depreciation. Either you purchase in middle of the year, start of the year, end of the year, you have to charge the complete depreciation of the entire year. And there would be no depreciation charge in year of disposal. Either you sell any time period of the year, you are not going to charge depreciation on the year of disposal. So let's read the requirement number 1. Calculate the depreciation charge for the year ended 31st December 2023. Now it's easy. We would follow the depreciation policy and find the depreciation charge for the year. So let's calculate the depreciation charge for 31st December 2023. Let's start with the cost. At the start of the year, that was $440,000. We had purchased, business has purchased 2 additional vehicles at the cost of 70,000. Add them. Purchases of 2 delivery vehicles at 70,000. And that it was purchased on 1st April 2023. You will going to ignore this amount because the depreciation policy is to charge completed depreciation in the year of purchase. So we are not going to charge on a monthly basis. The complete year depreciation will be charged. I am adding $70,000 to the original cost. Then you are going to deduct disposal of the delivery vehicle, because again the policy says there would be no depreciation charge in the year of disposal. So you need to deduct that cost of particular non-current asset that is being disposed during the year to fulfill the requirement of the examiner. So the cost, the vehicle which had originally cost at $28,000 were disposed during the year. So I would deduct $28,000 from this figure to find the remaining cost of delivery vehicles held at the end of the financial year. That would be 440 plus 70 minus 28, you will get $482,000. So the policy is straight line, it is applied on the cost. I found the cost at the end of the financial year. You can find depreciation now. Therefore, depreciation charge would be $482,000. Multiply it by 20%. There is no scrap value. So you just need to put a percentage onto the cost, 20%, that is 42,000 into 20%, you will get $96,400. That is your answer. So again, it's an easy concept. You just need to follow the policy of the examiner. The policy was full depreciation is charged in the year of purchase. So I have added $70,000 to the cost at the start of the year, and there were no depreciation charge in the year of disposal. So you need to deduct the cost of asset which is being disposed, that is $28,000 from the cost. You will find the remaining cost of delivery vehicle on which you need to put a depreciation percentage using a straight line method. So I hope this part is clear to all of you. The next part says, prepare the company's ledger accounts for delivery vehicles, provision for depreciation and disposal of delivery vehicle for the year ended 31st December 2023. You have found a working of depreciation. They have given you marks for that. So half of the requirement is done. You just need to find the accumulated depreciation of the asset that is being disposed. So let's begin with the question requirement. Delivery vehicle cost account. And you just need to make account for only 1 year, that is December 31st 2023. So starting from 2023 January 1st, balance brought down of delivery vehicle was for $40,000. 2023 at the start of the year, the balance BD of provision for doubtful debt account was also given. Provision for depreciation was also given, that is $270,000. that is the balance BD of depreciation account, $270,000. And let's start with the other elements of the question. In 2023 on April 1st, company has bought 2 additional vehicles from L Auto. So general entry would be vehicles debit, L Autos credit. So on the debit side of delivery vehicle account, you need to write April 1st, L Autos, and you need to write $70,000 over here. And there was one disposal as well. On 30th November 2023, the business sold one of its vehicle which it originally cost at $28,000. I am repeating myself again. If you dispose any non-current asset in the cost account, you have to mention the cost at which it was first bought. So on the credit side of my cost account, there would be November 30th. You are going to write disposal over here, and you need to put a cost figure. Okay, so the cost account is done. You need to balance it off. I am changing the color. The total of the debit side is $510,000, and the total of the credit side should be the same. December 31st, balance CD would become 510,000 minus 28,000. You are going to get $48,000. Balance it off. 2024 January 1st, balance brought down for $82,000. This account is done. Let's come on to the provision for depreciation account. I am again changing the color, going back to blue. On December 31st, you have found the answer of income statement charge, that is depreciation charge for the year. The answer was 96,400. Just put it over here. 96,400. There is only one element left, that is November 30th, the disposal figure. And what is the disposal figure over here? The accumulated depreciation that is charged on the asset or that is being disposed for the previous years. So in this question they have already given it. I am reading the paragraph again. On 30th November 2023, the business sold one of its vehicle. The vehicle had an original cost of 28,000 is accumulated depreciation. They have given you the accumulated depreciation amount of 16,800 that is being charged in the previous years of asset that is being used in the business. So 16,800 is the accumulated depreciation that is given in the question. So you just need to put it over here. 16,800 debited. Account is complete. Just balance it off and wrap up with this question. The total of the credit side is greater than the debit side. The total of the credit side is 366,400. 366,400, and on December 31st you are going to get balance CD amount over here, that is 366,400 minus 16,800 will give you an answer of 349,600. Balance the account. 2024 January 1st, balance brought down 349,600. So just make a habit to put balance PD figures of the next year as well, because it is must requirement for all the questions to show balance PD for the next year. So disposal account, let's wrap it up. We have all the figures to close up the disposal account to find the profit or loss that is being incurred. 2023 November 30th, disposal was done on November 30th. The cost of delivery vehicle was $28,000. The provision for depreciation that is being charged for the previous year were 16,800, already given in the question, and the asset was sold at a price of $10,500 to a local garage who paid by bank transfer. So you have received the amount by bank. Transaction would be bank debit and disposal account credit. 10,500 will be credited to the disposal account. I'm writing bank over here. 10,500. Let's find out either we have done a profit or a loss. Debit side is heavier, credit side is lighter. So there is income statement amount that is coming on the credit side. $28,000. $28,000. Deduct 16,800 and 10,500 from $28,000. You will get an income statement amount of $700 over here. That means it's a loss on this particular delivery vehicle that is being disposed by the business. So I hope question requirements are clear to all of you. There are 3 accounts that need to be made in this particular chapter, that is cost account, provision of depreciation account, and a disposal account. So you just need to be very much concise on your workings of depreciation and accumulated depreciation of the particular asset that is being disposed, and rightly do so. You need to understand the policy which is given in the exam. So I hope this question makes sense to all of you. And the next part, there is a theory. So the calculation part is done. I hope you have got it. I'll do one more question that would relate with reducing balance method to make it more clear for you if they have given a reducing balance method how to solve that particular question. Alright everyone, let's start with another question on depreciation. That is, I'm picking up a question of November 20, paper 23, question number 1, and syllabus code is 7707. That is your O levels Cambridge exam accounting paper. Let's begin with the question. Saria owns a business selling ladies' clothing. She maintains a system of double entry bookkeeping. The following occurred during September 2020. Purchase a motor vehicle on credit from Sharp Motors. Ruhi, a credit customer, was declared bankrupt, owing Saria $1,200. The debt is to be written off. Okay. Prepare the journal entries to record the above transaction. Narratives are not required. Okay. You just need to pass the journal entry in this transaction. Let's solve it. Transaction number 1. Motor vehicle purchased on credit from Sharp Motors. So motor vehicle would be debited. It's an asset. Asset increases on the debit side with 6350, and Sharp Motors will be credited with the same amount 6350. It's a liability. Liability increases on the credit side. Next up is Ruhi, a credit customer, was declared bankrupt, owing Saria $1,200. The debt is to be written off. It's a bad debt. It's a recoverable debt. It's an expense always recorded on the debit side. So in the next transaction, I will record irrecoverable debts on the debit side, and Ruhi, the name of the customer who has gone bankrupt, will be credited with $1,200. So first 2 transactions are done. Next step is Saria is preparing her financial statement for the year ended 30 September 2020. Now the year end is quite important over here. If the accounting year ends at 30th September 2020, we are going to go 12 months back. It must have started on 1st October 2019. So your starting date would be 1st October 2019, and your year end would be on 30th September 2020. She provides the following information for fixtures and fittings. 1st October 2019, that is balance brought down. Fixtures and fittings 28,600 is the cost. Provision for depreciation is 6185. These are the balance BDs of the 2 relevant accounts, cost account and provision for depreciation account. Next step is January 31st 2020, sold fixtures and received a check. There would be a disposal involved in this question. The fixture had been purchased on 1st February 2018 for $1,500. That is its cost. Purchase March 31st purchase new fixtures paying by check $3,500. Okay. Now the most important part is the question policy. What the policy says is the most crucial part to understand in order to solve the depreciation or to find the equivalent depreciation of a particular non-current asset. SARIA's policy is to provide depreciation on fixture and fittings at 10% per annum using reducing balance method. A full year's depreciation is charged. The most important line is written here. A full year's depreciation is charged in the year of purchase, but none is charged in year of disposal. So, whenever you are purchasing a non-current asset, any day of the year, you are going to charge complete year depreciation. And if you are selling a non-current asset during the period, you are not going to charge depreciation on that particular non-current asset. So the policy is the most important, the most crucial element of the question of depreciation. You need to get the policy right in order to do a correct working to solve the question. Okay. So let's begin with the requirements. You have to make fixtures and fittings account, that is cost account, for the year ended 30th September 2020. We have to make provision for depreciation account, and we have to make also a disposal account for 11 months. So let's start with the working first. Year started in 2019, October 1st, balance brought down was given for the cost account, that was 28,600. And in 2019, October 1st, the balance brought down of depreciation was also given, that was 6185. Now let's see which asset is purchased. March 31st, 2020. You are going to change the year 2020. March 1st. March 31st, purchase a new fixtures paying by check. General entry would be bank debit, fixtures debit and bank credit. So in the fixtures cost account, bank would be debited with the amount of $3,500. Over here, 31st, I will write bank with the value of $3,500. It's a new purchase and it's a cost account. Cost increases on the debit of non-current asset, decreases on the credit. And on 1st January, previously bought fixture was sold, which had a cost of $1,500. In the cost account, you need to put everything on the cost figure. So on the credit side, I will write 2020 January 31st. I will write disposal over here with the value of $1,500. So always remember to put a cost figure in cost account. Either you are purchasing it or either you are disposing any asset. The account is closed, the account is done. You need to balance it off. The total of the debit side is 32,100 and the balance CD figure would be on September 30th. 32100 minus 1500, you will get a balance CD of 30,600. October 1st, balance brought down 30600. Cost account is completed over here. Next step is provision for depreciation working. So I am going back to the question area to use the space for working. Now again, I need to find two figures over here. One for year end September 30th. Income statement charge, that is depreciation for the year. That would be my working number one. And in 2020 there was a disposal on January 31st. I will add disposal and I will find accumulated depreciation of that particular asset which is disposed during the year. That would be working number 2. After finding these two workings, after finding these two answers, you are going to balance it off to find the balance CD figures and balance BD figures of the next year. So let's start with working number 1. Going back to the question. The policy says full year depreciation is charged in year of purchase but none is charged in year of disposal. The policy is 10% using reducing balance method. Let's start with the working. Income statement charge. So reducing balance method says that depreciation is applied on net book value of a particular asset. To find net book value, we would deduct accumulated depreciation from the cost of the non-current asset and multiply it with a given percentage. So the starting cost of fixtures were $28,600 and provision for depreciation of fixture and fitting at the start of there was $6,185. So if I deduct accumulated depreciation from this cost figure, I will find net book value of fixtures and fittings at the start of there. I hope it's clear to all of you. So deducting 28,600 minus 28600 minus 6185, you will get 22415 dollars. That is a net book value at the start of there. So I'm writing net book value on 1st October 2019 dollar 22415. Then I will add new fixtures that were bought on March 31st 2020 with a cost of $3,500. I will add this figure to the net book value of the start of there. Why? Because the policy says that the full year depreciation is charged in year of purchase. So irrespective of any time of the year you are purchasing a non-current asset, you will put a depreciation of the entire year. So I will add $3,500 to the net book value of the start of the year, and then I would deduct disposal of fixtures that was done on January 31st 2020. Now it's a reducing balance method, so you need to deduct a net book value of that non-current asset that is disposed. Why I am deducting this disposal from here? Because the policy says that no depreciation would be charged in year of disposal. So I have to deduct that net book value from the opening net book value, because that particular non-current asset must be added into the opening net book value because it is carried forward from the previous year. So we need to deduct the net book value of that particular asset from the net book value at the start of the year to apply the policy correctly. I hope it's alright for all of you. You have understood the concept. I will deduct disposal from the opening net book value in order to apply the policy correctly. So what is the net book value of the sold asset? The fixture had been purchased on 1st February for amount of $1,500. And it is sold and received a check of $1150. You have received a check of $1150. So I will find a net book value after finding accumulated depreciation of that particular asset. So let's start with working number 2 to find a net book value of the asset that is being disposed by the business. Net book value of disposal. Now here it comes the role of the timeline. Always make a timeline in your question paper in order to avoid any error. The asset which was disposed was first bought on February 2018. 1st Feb 2018. That accounting year was ended on 30th September 2018, that is your year number 1. Second year was started on 1st October 2018, ended at 30th September 2019, that was your year number 2, which in which the asset was in use. And the third year was started in October 2019, ended at 30th September 2020. That is your accounting period in which the depreciation would not be charged because asset was disposed, or according to the policy, the depreciation was not charged in the year of disposal. So you need to find depreciation over the previous 2 years in which the asset was in use. So for the first year, the depreciation charge must have been, the cost of that asset was $1,500 minus 0. There would be no accumulated depreciation at the start of the first year, into 10%, $150. For the next year, $1,500 minus 150, that is reducing balance method. You need to find deduct depreciation of the previous year from the cost and then apply the percentage figure over here. Over here you will get $135. And the third year will not be charged. So the depreciation charge for this fixture was for the 2 years that was in use, and the accumulated depreciation would be $285. I hope everyone have got this concept. Now we can easily find net book value, that is cost minus accumulated depreciation. Cost is $1,500. Accumulated depreciation we have found $285. You will get $1,500 less 285, $1,215. So this is the net book value of the asset that is being disposed by the business during the year. I will deduct this amount from the net book value 1215 to find net book value at end of the year, that is net book value of 30th September 2020. $22,415 plus 3500 minus 1215, you will get 24700. So I am repeating all the workings again. What we have done over here, the policy was reducing balance method, and the reducing balance method is applied on net book value of the asset. To find net book value, we have to deduct accumulated depreciation from the cost and then apply the percentage given in the question. In this particular question, the policy was to charge depreciation for the entire year in year of purchase, but none will be charged in year of disposal. So to make it easier to understand, I will find net book value of all the assets that are being used during the year. To start with the working, I had deducted 6185 from 28600 to find net book value of the start of the year, that was 22415. Then I have added $3,500, a new asset purchased during the year, because the policy says again completed depreciation will be charged in a purchase, so I am ignoring the month at which it was bought. I will add entire figure to the net book value, and then I had to remove the net book value of the asset that is disposed from the net book value because it was added before the year start, and it must have been in the net book value at the start of the year. So I need to deduct that net book value because the policy again says no depreciation is charged in year of disposal. So how did I find 1215? In a separate working, I found the net book value of the asset that is sold. It was first purchased on 1st February 2018. The year ended was on 30th September 2018. That is year number 1. The next year started on 1st October 2018, ended on 30th September 2019. That is your year number 2. And the third year started on 1st October 2019, ended on 30th September 2020. That is a period in which depreciation would not be charged, that is year of disposal. So I had to find depreciation that is charged for the 2-year time period. The first year was 1500 minus 0 into 10%, and the next year 1500 minus 150 into 10%. So the accumulated depreciation of that asset was 285. Then you can find easily the net book value, that is cost minus accumulated depreciation. 1500 minus 285, you will get net book value of 1215, which will be deducted from the net book value given in the working number 1. So now that is easy. September 30th, you will have got your net book value. Then I will apply 10% figure over here to find income statement charge of depreciation. That is $2470. Now both the workings are done. We have found the accumulated depreciation of the asset that is disposed as well. I found the depreciation charge of the asset as well. Now we need to just put it in the ledgers to close the ledgers for the year end. So let's start with the ledgers. Provision for depreciation of fixed and operating, working number 1. We have got 2470. The disposal, that is the disposal figure, the accumulated depreciation of the asset that is disposed, that is also found, which is $285. Account is done. You just need to balance it off. The total of the credit side is 8655, and the balance CD figure on September 30 would be 8655 minus 285. You will get 8370. October 1st, balance brought down 8370. The depreciation account is done. Now disposal account is easy. You have got all the workings. Disposal was done in 2020 on January 31st. January 31st. The cost would be debited. The cost of fixtures were 1500. The provision for depreciation in working number 2, we had found $285. The asset was disposed and received a check of 1150. It will be credited. The double entry would be bank debit, disposal account credit. Disposal will be credited with the amount of bank 1150. Now you just need to find either there is a profit or a loss. The debit side is higher, and then the credit side $1500. You will get income statement amount of 1500 minus 1150 minus 285. There is a loss of $65. So in this particular question, we have done using reducing balance method. There is a loss on disposal of fixtures during the year. There are some points that need to be considered when you start a question on depreciation. Number 1, the policy. Number 2, how the depreciation is being charged. Either they will say completed depreciation will be charged in both year of purchase and in disposal. Either they would say completed depreciation is charged in year of purchase, but none would be charged in year of disposal. Either they would say depreciation will be charged for the time the asset is being used for the business. So these 3 lines are the most crucial, most important lines in any of the depreciation question. You need to know how to make the cost account. Everything would be on the cost. You also need to know how to make a provision for depreciation account. You need to do 2 workings over here. One is income statement charge, another is accumulated depreciation of the asset that is being disposed. And in the disposal account, you will find a profit or a loss on disposal of the non-current asset. So we have done 3 different questions to illustrate the concept well. We have also done the lecture on the depreciation. It's an easy topic. You just need to work on your workings. And if you find any difficulty in another question, you can drop me a message. I will inshallah try to help you out. So if you like the video, kindly like it, share it, and do press the ring bell icon for upcoming videos. Thank you so much.